What's up everyone, it's Scotty with MoneyVest. So in this video we are going to be talking about a mind-blowing statistic which is now approaching levels that we haven't seen since 2021, and also just the sheer exuberance and the momentum behind this entire bull market is what we have been witnessing over the last 3 months as we close out the first quarter of 2024. I mean, year to date, the S&P 500 and the NASDAQ has been incredibly strong. So I'm going to break down everything you need to know in this video for the market momentum. There's a lot of really interesting statistics to break down. As always, make sure that you drop a like and don't forget to subscribe to the channel. If you're just joining us for the first time, the link to our Discord and Patreon is going to be down below. If you're interested in joining us and of course getting access to all the members only private videos, including all the trade alerts and the trade ideas. And there is a 16% annual discount that's available until the end of this month. So 2 more days left if you are interested in taking advantage of that as well. Now, even though we have seen this B of A bull bear indicator, which is essentially telling us, how the momentum is and how sort of extremely bullish or bearish the markets are. Even though this indicator has dropped down to 5.8, that's down from 6.1. So of course, at one point we were, in this range between 6 and 8. Of course, at one point we were also above 10. This indicator has somewhat come down a little bit. This right here is essentially from Charlie Bilio, which essentially shows us how strong this bull market is if you go back over 100 years. So what this is essentially telling us is that if the year ended today, so if March 31st, 2024 was the end of the year, the S&P 500's maximum drawdown of 1.7% would be the smallest of any year in history. Any year in history. This is not in the last 20 years or 30 years or 50 years. Anytime in the history of the stock market, this would be the smallest drawdown for the S&P 500 of 1.7%. 1995 currently holds the record with a max drawdown of 2.25%. So if you come over to this chart and take a look at 1995, the maximum drawdown on that year was 2.5%. That is it. Now just imagine how strong the markets were in 1995 with a 37% rally on that year. And even in 1975, so you go back 20 years, 37% rally in 1975 as well, but that came on the back of incredible amount of volatility and a 14% drawdown for that particular year. If you go back to 1951, 23%, 1950, 30%, but again, that came on the back of incredible amounts of volatility, down about 14% and down 8% respectively during those years that we saw the drawdown for. So essentially what I'm saying is VIX right here is dead. Basically, VIX is essentially dead. And what that means is volatility is so low. It is so low in the market right now that we are not even able to pull down 2% on the S&P. Every time we get a 0.5%, 1%, 1.5% pullback, the markets get bought up here very quickly. And so far, of course, year to date, we're up a little bit over 10.6%. So significant amount of momentum. And again, you can see this is the smallest drawdown for the markets ever in the history of the markets, which just goes to show that there's lack of volatility in the market. Volatility is quite literally dead at the moment because we're not really seeing so much, fluctuations in the market. Really, we're seeing a pullback. It's getting bought up fairly quickly. Now, this right here is the market cap of the largest stocks relative to the 75th percentile. And I want to draw your attention to this chart in 2023-2024 in where we are with respect to, again, the market caps of the largest companies. And then relatively speaking to the other 75th percentile of the stocks, it is now higher than its 1932 peak, right? So 1932, we were at well over 750 times, and this number right now in 2023 or 2024 now rather is sitting at well over that peak from 1932, which again is concerning. It is now starting to really get to really extreme levels, and again we did see a little bit of a higher level in 2020, and then of course we did see a bit of a pullback. We saw a pullback, of course, in 2009. We saw a significant amount of pullback in 2000. We saw a pullback in 1970s. Saw a pullback in 1960s. Saw a pullback in 1939. Saw a significant amount of pullback in 1932 because of the Great Depression. And now 2023, 2024. Why is it going to be any different, right? That's the question I have for you, is that why is it going to be any different? Because the market caps of these businesses are just astronomically high compared to some of the other industries and stocks and sectors in the S&P 500 or in the market in general. Now, some may argue that, times are different. This time is indeed different. And those are some of the most dangerous words in the stock market because, technology has taken or evolved a new sort of version with artificial intelligence. I mean, a lot of these companies are well established, super profitable with very strong cash flows, excellent balance sheets. So maybe there's an argument to be made that, that now the companies, the technology companies are different, from what we have witnessed before. And for that reason, we're maybe not going to see a pullback or a correction or a crash like we used to in the past. But again, companies and investments and stocks can be the best out there. But if they are trading at overpriced, overvalued, rich levels, then it's all the same, right? I mean, you can make a great investment into a terrible investment if you simply overpay on that investment, right? You can have two fantastic investments, but the person who overpays will have lower returns in the future versus the person who underpays, gets a good deal, and buys it at an undervalued level. You can even make money by buying a bad investment at an undervalued level, right? If you buy, because as Peter Lynch says, that you can actually make money when businesses go from really, really bad to somewhat okay to really good businesses. And you can also make money while investing in good businesses that turn into great businesses. So there's money that can be made both ways. It's just about pricing. It's just about valuation at the end of the day. And that's really what I'm here to teach you on the channel, is that understanding risk and reward, understanding valuations will go a long way in your way of analysis and understanding of the markets, because it doesn't just apply to the stock market. It applies to everything else in life as well. It's just how you view the world in terms of that risk and reward, and understanding the value, the transactional value that you're getting when you're investing in a company, investing in a stock, investing in real estate, investing in whatever, and what are you getting out of it? So that's really, at the end of the day, is what we have to consider. Now, this right here is Carl Quintanilla, and he said that Apollo mentioned that S&P 500 is up 25% since November FOMC meeting, and a $10.9 trillion increase. For comparison, the U.S. consumer spending in 2023 overall was $19 trillion. So we have already seen almost a 50% of the consumer spending in 2023. The wealth gain has been close to $11 trillion. Just think about that for a second. The wealth gain in the stock market is 13.5 trillion since November FOMC. I mean, that is just incredible. That's accounting for both the U.S. stock market and the bond market. And $10.9 trillion worth of wealth gain or growth in market cap came from U.S. equities. That's the growth in market cap of U.S. stock market. Absolutely insane and mind-blowing statistics here of how much wealth creation we've seen in the last 6 months since November of 2023. Now, amid all of this momentum, amid all of this euphoria, exuberance, and market momentum trading at all-time highs, and of course, the smallest drawdown, volatility is low, markets at an all-time high, so much wealth creation. Peter Thiel, Jeff Bezos, and Mark Zuckerberg are some of the many insiders that have been selling. So they've been kind of joining in the parade of corporate insiders who have sold hundreds of millions of dollars their companies' shares this quarter, in a signal that recent stock market exuberance could be peaking. And this is first quarter 24, what I'm talking about, not last year, first quarter 24. And this right here is another statistic that I think everyone needs to be aware of and where we are. So this right here is a ratio of insider sellers to buyers. Basically, what this means is that if this ratio is, let's say, positive, that means there's more sellers than buyers, insider sellers versus insider buyers in the stock market. If this ratio is obviously negative, which it hasn't been before even 2016, it's always been positive. That means there's been, on a net basis, there's more insider sellers than there are insider buyers. Now, really, the question is not so much about whether it's positive or negative, but to what degree is it positive or negative? And really what you'll notice is that in 2019, we saw insider sellers to insider buyers at a close to 14 to 15 level. So that was obviously a very, very significant level. And then we saw a pullback in the S&P 500. Now, this right here does not do justice of how severe that pullback was towards the end of 2018 and 2019. This was still a bear market. Be mindful that this was still a bear market. This right here was back in 2021. So again, we saw that peak of well over 13.5, close to 14. What followed was obviously a pullback in the S&P, or actually the NASDAQ in this case. And again, insiders know what they're doing, right? Insiders by all means know what's going on in the economy. They've got a much better, much more clarity, much more sort of a, insight into what's going on in the economy, in the market. So if they're making decisions, and as I've mentioned before, in my previous videos, that insiders buying versus insiders selling, right? Buyers always know that if you're buying something, there's more likely that you've got, you see value, you think that there's potential to make money here. But if you're selling, you could be selling for multiple different reasons, right? You could be selling for a lot of different reasons, but you're only buying for one reason. And so keeping that in mind, but once you start to see this number kind of accelerate, I mean, not everyone can be selling for different reasons, right? If you see so many insiders now starting to sell stock on a net basis, that should tell you something that, okay, markets have really pushed higher so much that even the insiders are taking some weight off the table, taking some profits off the table here, and they're kind of lighting up on their positions a little bit. So something to keep in mind, because we're now approaching that peak from back in 2021. Again, that was right before the bear market of 2022. So just putting it out there. Of course, this is not part of any type of FUD or fear mongering or anything, but this is just statistics, and we cannot ignore statistics and data here because we're back to the 2021 level. And finally, Amazon founder Bezos sold 50 million shares of Amazon at worth $8.5 billion. And then, of course, we had Andy Jassy selling about $21.1 billion worth of stock this year. Zuckerberg selling about 291,000 shares of Meta at about $135 million per for the entire position here. He still has 13.5% of the company. And this right here was Verity's vice president of research, Ben Silverman, says, and I quote, "We do view the corporate insider share sales as a negative data point that investors should be aware of." And he added that within the technology sector specifically, we're also seeing a number of big company names in this space with insiders selling that is not typical, right? It's not cyclical, it's not seasonal, it's just not typical. It's very unusual for insiders to be selling at those companies at this time, and for that reason, it is definitely something to be aware of, and it could be a negative data point for the market, which could lead to a potential pullback or a correction that we need to be aware of. Clearly, there's an appetite for liquidity generation right now. And some of that is some pent-up demand following relatively quiet insider selling in 2022 and 2023, and certainly one impetus is stock market performance as well. So bottom line is, we've got a market where volatility is really low. We're not seeing a lot of drawdowns. 1.7% max is nothing. And then if you compare that, with the markets continue to push higher to all-time highs, insiders now starting to look at some, de-risking and some lightening up on their positions on a net basis. That level is coming up to 2021 again. All I'm going to say is just be careful. Obviously, this is a market where I'm personally just holding. I'm not aggressively buying in this market because I know the valuations are too expensive. And on a risk-adjusted basis, the upside potential compared to the downside potential is just very unfavorable, right? So the downside potential is far outweighed or is basically weighted heavily compared to the upside potential that the market carries right now. And for those reasons, I'm just kind of in that hold zone. We'll most likely be selling some calls again. And then, of course, if we do set that volatility spike here, markets draw down, that's when I'm going to be ready to deploy some serious cash back into the market. And for that, I will be sending out a lot of alerts in the community in our Discord. So link's going to be down below if you want to join, be a part of our MoneyVest community here. As always, happy investing, and make sure that you drop a like, subscribe to the channel. See you guys in the next video. Take care.